Most people overpaid for life insurance by 30 to 40% and never even realize it. Why? Because they never see how the quotes are actually built. In this video, I'm going to show you the hidden system that controls what you pay for all types of life insurance. Show you how one change can get you 40% more coverage for the same dollars, and tell you the truth about those TV ads that promise no medical underwriting, the TV ads that say you cannot be denied coverage. Stay till the end because it's not what most people think it is. Hello, my name is Diane Robin Johnson. This is the Wealth Advocate channel, and I am your personal wealth advocate. This is part 1 of a 2-part series, so remember to watch part 2. And today, I'm also giving away a free ebook on the 10 life insurance mistakes that can absolutely wreck a family's financial plan, including one painful example from my own family. Here's what most people do not understand about life insurance. You do not get more coverage for less money by chasing the cheapest quotes. You get more life insurance for less money by getting placed in a better health classification. So, the smart order of operations is this. First, find the companies that are most likely to place you in their best health tier. Then and only then, you shop for price within those companies. Health first, price second. And that is how smart consumers shop for life insurance. Let me show you an example. Let's take a 45-year-old non-smoking woman. We'll call her Lady Williams. She wants a term policy. She wants to pay $1,500 a year, and she wants a 20-year term policy. She's in a standard health classification, which means insurance companies put her in average health. Now, here's where it gets interesting. I took one major insurance carrier, and I ran Lady Williams through every single tier. The result? Different health rating, completely different coverages. This is the health classification category that underlies all life insurance premiums. At $1,500 per year, if she qualifies for super preferred health rating, she gets $2 million of coverage. She drops down just one category to the preferred health rating, she gets about $1.7 million. That's about a 15% drop in coverage for the exact same money. If she drops down again to standard plus, she gets about $1.2 million of coverage. So think about that. She went from $2 million of coverage to $1.2 million of coverage for the same annual premium. That's about a 40% drop in coverage for the same dollars. And that 40%, it matters in real life. That can be the difference between paying off the mortgage or leaving that burden behind, between funding college or not, between protecting your spouse's retirement or forcing one tragedy to become two. And below standard, it gets even more serious. Most people do not know this, but there's also what's called table ratings. These are for people who are considered less than average health. They usually start at a table A or table 1, and then they move down through the categories, getting worse and worse health each time. The lower the rating, the less coverage you get. For the example I ran, Lady Williams gets $2 million of coverage at the highest tier, super preferred, and the lowest tier, she only gets $331,000 for the same budget. Completely different outcome. This is why understanding the hierarchy of health classes matters so much. And by the way, I put the definitions of what insurance companies mean when they say super preferred, standard, and all the various table ratings. I put it in my free ebook, link below in the description. And this is exactly why you need to watch part 2, because in part 2, I'm going to give you the strategies that many people use to improve your exam results so you can move up a category or 2. And when you move up a category, you get more coverage for less money, and or if you're looking for permanent life insurance, getting a better health class means you're paying a lower cost of insurance, which means every dollar you put into the policy goes more towards building up cash value and less goes towards paying for the life insurance policy itself. Now, this becomes even more important when you have health history. Here's what you need to know. Underwriting is not a one-size-fits-all structure. Different carriers have different underwriting sweet spots. Some companies are more experienced with certain conditions, and because of that, they may give you a better rating and rate you more favorably than another company. Some carriers are very strong with diabetes underwriting. They have studied it. They understand it. They know how to assess A1C ratings, age, medications, stability, age of onset, and overall risk. And because they understand it better, they may give someone with diabetes a much better health class. Another company that doesn't specialize in diabetes may simply see the word diabetes, panic, and put you in a lower table rating with a much higher premium. That's a massive difference. So you're not just shopping for policy, you're shopping for the underwriter that likes your story. That is the move. Because it's a waste of time to go online comparing rates based on quotes that assume you will get preferred rating or standard rating if when you actually go to submit your application, the company is going to give you a standard rating or worse. As I've already shown you, the most important factor affecting what you pay is the health class. So first identify the companies most likely to place you in the best classification and then compare prices among those companies. That is how you shop intelligently. And yes, I'm also putting in my free ebook, which carriers has historically been best for which conditions. Now let's talk about those ads. A lot of people get misled, especially people who do not have perfect health. They see these commercials that say, no medical underwriting, no medical exam, you cannot be denied coverage. And they think they found a shortcut around the underwriting system that I just explained, and they have not. Let's start with the phrase, no medical underwriting. The wording is technically true, but it's still misleading. Here's the real deal. No medical underwriting usually means no blood, no urine, no nurse's visit, but it does not mean no underwriting. They're still going to underwrite you. They're going to ask you health questions on the application. They may still check your prescription history. They may still pull your Department of Motor Vehicle report. And for larger policies, they may even look at financial information. So underwriting is still happening. It's just without the lab work up front. And if your medical history raises concern, guess what? They're going to come back and ask you for labs anyway. Now, to be fair, there's nothing wrong with these policies. If you're younger and you're in excellent health, they can be really convenient. You may skip the hassle of the medical exam, and sometimes the rate is perfectly fine. But there are times when, if you're truly in excellent health, you might be better off going through full underwriting because you can actually prove with your lab results that you have good health as opposed to just being in the insurance company's statistical models. Now let's be honest. Did you really think that an insurance company is going to give you a large life insurance policy to someone with stage 4 cancer with no questions asked just so that they can collect a few months of premium and then pay out hundreds of thousands of dollars in insurance to the beneficiaries? Of course not. It's not true. They would go out of business. So when something sounds too good to be true, it usually is. Now, sometimes the commercials say something different. They say, you cannot be turned down, guaranteed issue life insurance. Now that's a different product. And this is where people get burned on that product because they think it's just easy life insurance. And again, it is not. That is why the coverage amounts are usually very, very, very low. Often $5,000 to $25,000. And the cost per dollar of insurance is very, very, very high. This is generally final expense insurance. It's not designed for replacing income or paying off a mortgage because the amounts are so low. Here's the real gotcha with those policies. Yes, they may give you the coverage, but most of those guaranteed life insurance policies, all the ones that I've seen, have what's called a graded death benefit, which means if death occurs in the first 2 years from natural causes, they will pay you nothing. That's the gotcha. And that's the part that most people miss. So yes, technically the policy is guaranteed issue, but that does not mean you're going to collect from it. So now, the next time you see one of those commercials on TV, I want you to think, that's what Diane on the Wealth Advocate channel was talking about. Now, you know the truth. Remember to subscribe so you can keep learning and make smarter financial decisions. And don't forget to watch part 2. And don't forget to download your free ebook. Thanks for watching. See you next time. Bye-bye.